Hi, thank you for joining me today. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. I'm now going to start with an economic overview, which was written by Harvey Katz, our chief economist. The case for an interest rate cut was building as July concluded, and the Federal Reserve, earlier today, lowered rates by 1/4 point. In the weeks leading up to today's gathering, Fed officials had cited a lack of improvement in the U.S. business outlook, questions about the global economy, lingering trade concerns, and the risk that inflation would stay below the Fed's comfort zone as reasons for its likely decision to lower rates. Reducing interest rates this year would appear to be a preventative step longer term. Indeed, the business upturn, albeit weaker than earlier this year, likely would continue in 2019, even without help from lower rates. But the Fed also may be looking overseas, where growth is stumbling, and at the inability to lessen trade tensions, even as key talks were to resume with China, as justification for cutting rates now. The bank is hoping to get Americans to borrow and spend more in an effort to keep the expansion in place beyond 2019. Meanwhile, business is slowing down, with the latest data showing a flattening in industrial production, uneven trends in housing sales, and a decline in leading indicators, the first such setback since late December. As well, inventories of unsold automobiles are swelling, and Boeing's challenges may have a significant ripple effect. The moderating pace of activity likely will continue in the second half, with the expected lowering of rates over the next year designed to prevent a more serious slowdown thereafter. The moderating business advance is affecting profit statements. True, most companies that have reported second quarter results have beaten forecasts, but a greater percentage of corporations than in recent quarters have failed to exceed their targets. This is not surprising, given the slowing pace of economic activity and the uncertain trade outcome, both of which are delaying business investments. The market is overcoming these headwinds so far, remaining near earlier highs and even breaking new ground. Lower interest rates and overall earnings strength are helping this performance. In conclusion, we think Wall Street's outlook is sufficiently bright for investors to stay in the game, even with the occasional corporate swing and miss. Overall, I would qualify Harvey's view as mostly positive, and we can use details of his overview to put together a strategy to find a stock to buy right now. Before we formally start our search, please note that I am already signed in as a subscriber and I'm on the Value Line dashboard. From here, I can access all of the products, as well as view daily market commentaries and analyst reports on reporting Dow 30 companies. On that note, As you probably know, we are in the heart of earnings season. During this time, in order to keep our subscribers informed in regard to new information and changes in our analysis and recommendations, we publish supplementary reports that are immediately available. These can be accessed from the quick links. As you can see, we've created dozens of reports over the past few days. We strongly recommend that subscribers come to this page on a regular basis. Let's now start our search for a worthwhile investment candidate. For this, I'm going to head to the screener, which can be accessed right here at the top. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's look at articles that will generate a list of stocks that are expected to outperform the broader market over the near term. Value Line's time-tested timeliness ranks are a good place to start. The ranks range from 1, highest, to 5, lowest. Although the calculation is purely quantitative and proprietary, I can tell you that it includes a number of variables, including stock price momentum and earnings results. So simply click on the field on the left and fill out the criteria. For this, I'm going to select the 1s and the 2s, since those are expected to outperform the market over the next 6 to 12 months. If you would like more information in regard to Value Line's ranking system, I encourage you to consult the user guide on this very topic. It can be accessed free of charge via the investment education section of our website. There are also various product-specific guides that will help investors get the most out of their Value Line subscription. Next, let's make sure that earnings are on the upswing. To start, I'm going to utilize EPS growth over the past 5 years. And let's set the low end to 15%. I also want to tap into Value Line's estimates. This is a good time to mention that Value Line is one of very few research houses that provide financial projections out 3 to 5 years. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company, and I'm also going to set the low bound to 15%. Lastly, I want to tap into one more Value Line proprietary measure. It is true that, at this time, we are rather bullish in regard to the market's near-term prospects, but it's usually never a bad idea to reduce risk, especially if it won't hurt our potential return too much. There are loads of metrics that can be used to assess quality and stability. One that I recommend is Value Line's safety rank. The safety rank measures the total risk of a stock and, like timeliness, is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For more information, I encourage you to peruse our ranking system guide. So I click on the safety rank field, and I want to focus on stocks ranked 1 or 2. These are financially sound companies, and their stocks have a history of relative stability. Down to 7 results, which is nice and manageable. All of these equities may fit nicely in a portfolio focused on the near term without taking on excessive risk. However, only one can be today's one stock to buy right now, and after conferring with several of my analysts, I'm recommending Argo Group, ticker ARGO. Before I dive into ARGO, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the digital report, where the information and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized report. Once you alter the presentation, you can save your changes from the sliding horizontal action bar. The next time you come to the report, it will look the way you set it up. And you can also apply these changes to other stocks. Argo Group is not a household name, so let's get into some information about the company. This is available via the Business Overview module. The Bermuda-headquartered corporation underwrites specialty insurance and reinsurance products in the property and casualty market worldwide. It has more than 1,400 employees and a market capitalization of about $2.3 billion. Moving on, our digital reports possess a great deal of information and analysis, and I can't cover every useful module. However, I do want to discuss a few features that highlight Argo's favorable prospects and investment merits. First, the valuation module shows the annual historical performance of the company along with our estimates for 2019 and 2020. A quick scan of the earnings and underwriting income shows that the company struggled over the past couple of years, but our estimates suggest a material turnaround. In fact, we expect sizable profit jumps this year and next. We also expect that growth will remain strong for many years to come, which is reflected in our 3 to 5 year projections module to the right. As you can see, we project that Argo will trade between $85 and $110 by the 2022-2024 timeframe. Its current price is around $69, which suggests solid appreciation. And you can get the current price right here at the top, along with the daily change. We are even more bullish for the near term. This is a good time to highlight a relatively new feature from Value Line that is only available to our subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict the stock's price over an 18-month horizon in terms of a range. And it's right up here at the top. In addition to the high and low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely profit potential. The larger the percentage, the greater the possible price appreciation. The 18-month target price range is only available for the 1,700 stocks covered in the Value Line Investment Survey, and this purely quantitative measure is displayed on all of our digital reports. We have also added the 18-month midpoint percentage to our stock screener. For Argo, its range is $64 to $127. The midpoint of that band is 96, or roughly 40% higher than the current price. If our 18-month estimate is accurate, investors will reap a significant reward. It appears that institutional investors also agree with our bullish stance. Let's take a look at that module. By clicking on the double-sided arrow, you can expand. As you can see in the last quarter, buys significantly outpaced sells by institutions. Clearly, from a numbers standpoint, there is a lot to like here. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available using the button on the top right. Let's see what our analyst has to say in the commentary. Many subscribers think that this is the most important part of our reports. Editorial analyst Kenneth DeFranco is optimistic in regard to Argo. Here is an excerpt. Argo Group's bottom line appears to be back on track. Like many of its peers, the company has greatly benefited from stronger pricing fundamentals across the reinsurance space. Meantime, a combination of tighter underwriting guidelines and fewer large catastrophe losses has helped bolster overall profitability. Elsewhere, the reinsurer has expanded its international footprint and instituted meaningful rate hikes for its excess and surplus lines, further lifting results here. The adoption of a revamped digital operating platform ought to reduce risk exposure, speed up the claims process, improve policy retention levels, and identify coverage shortfalls. These positive factors seem firmly intact at this juncture. Therefore, we have boosted our 2019 share night outlook by $1.60 to $7. This reinsurance provider looks poised to take another step forward in 2020. As for the stock, it is now ranked to outperform the broader market averages over the coming 6 to 12 months. Lastly, please note that Argo's stock price is actually a bit below our most recent report, and that it's scheduled to report June period financial results on August 5th. In sum, we think that Argo Group is attractively priced and that it will outperform the broader market over the near term. It is today's one stock to buy right now. This marks the end of our formal presentation, and I will now tackle your questions. All right, so give me 1 minute to go through them. All right, here's one question about the rate cut. And before I answer it, I'm going to go back to the dashboard because I do want to let everybody know that we've already published an article about it. So while I'm answering the question, we can view that. Would this rate cut and perhaps future ones lead to greater growth in smaller cap companies or indexes? I mean, if rate cuts spur economic growth, that will certainly help smaller cap companies and potentially lead to greater gains for indexes. Whether you agree with a rate cut at this time, I think is a pretty good debate. But it has the potential to do the stock market well, even though the major indexes did decline on the expected news today. Next question. Do you recommend an entry price for Argo? Well, I'm recommending today, I do believe that the current price is a good entry. I think anywhere 5 to 10 points in either direction would also qualify. I think it's appropriate price. And also, if we take a look at our report, at $75 a few weeks ago, it was only trading at less than 11 times earnings, and a pretty big discount relative to the overall market. I don't think this stock is expensive from really any valuation metric that I looked at today. What made you select Argo from the 7? As I mentioned, I conferred with a bunch of my analysts. If we go back to the screener, so I kept it open. All of these certainly looked like quality companies, and of course, a few of them are pretty heavy hitters, like Visa, MasterCard, Progressive. I like to pick a stock that most people maybe haven't heard of as part of it, but if you look at their numbers, for instance, just the criteria we used, they're very competitive, and they actually have far higher earnings growth potential than everybody else. But all 7 appear to be pretty good candidates. You reviewed the economic outlook at the beginning. Where did that come from? Well, I had it updated today, obviously, for the interest rate information, but we put out a weekly economic overview every week. Well, I should say every day, but there's also a proprietary one that comes out weekly in the Selection and Opinion. This is a newsletter that accompanies a subscription to the Value Line Investment Survey, and this content is always written by our chief economist. And then also on a regular basis, we'll do quarterly economic reviews and quarterly stock market overviews, which are much larger reports on what's going on in the market and in the economy. Can you find in the screener a dividend history beyond 5 years or number of years of uninterrupted dividend payments? Unfortunately, that can't be searched for. We have the 5-year numbers. I'm assuming you're looking for a dividend aristocrats kind of thing, companies that have increased their payments every year for decades. Unfortunately, we don't have that capability. Let me take a quick scan. That might be all of the questions at the moment. Thank you for attending. Thank you for all of your questions, and have a great day. As a reminder, if you'd like to replay this webinar, it will be posted on valueline.com and our YouTube channel within the next 48 hours. Thank you very much, and take care.